In this video, I'm going to show you guys the best entry confirmation that you should be using, and it's the exact one that I've been using in order to pass funded challenges and acquire capital. Okay, so let's jump straight in. Okay, we want to see a high in the market followed by a higher low, followed by a strong break to the upside. Okay, so in terms of raw market structure, we have a high, followed by a higher low, followed by a higher high. Okay, this strong move up has broke structure to the upside, and we can mark this on as a BOS to the upside. So we can mark this on as a BOS. We can then go ahead and mark on our guarded low, which is the invalidation level. We do not want price to close below here. This would invalidate our long bias. Okay, so if price, for example, comes back down and closes below our guarded low, that would indicate that the buyers are no longer in control of this market and the sellers may be looking at stepping into that market. Okay, so that's why we have the guarded low. We have an objective invalidation level. Okay, once we've identified the break of structure and our guarded low here, we can then mark on our extreme demand. So this is the only area where we as traders will be looking for a long trade. Okay, we mark this on within this impulsive leg here. Within this impulsive leg, there's going to be a down candle before this move to the upside. And that's exactly where we mark on our POI, or point of interest. Okay, we mark it on from the open of that down candle down to the low. Okay, we can also go ahead and mark on our impulsive move. And this is the only impulsive leg that we are looking at. Okay, we mark that on as a grey box. So we're not bothered about any other swing points in the market. We're only bothered about the most recent swing points and where the most recent orders have been accumulated from institutions. Okay, we're looking for price to come back into our POI, our extreme demand, and if we get a strong rejection out of this area here, so if we get a rejection out of the POI, then we can look for a long trade and look to target number one, TP1 equal highs here, which we can also mark on as the liquidity. And we're also going to be looking for some further continuation to the upside, reaching for all of the liquidity that lies above the equal high here. Okay, so equal high is a first TP and then further continuation. Okay, so just to recap the long bias, so the long setup, we have a high, a higher low, followed by a higher high. We want to see price come back into our extreme demand, which is the point of interest. So if and only if price comes back into the POI, if we get a strong rejection from the POI, from the extreme demand, then we can look for a long setup. So we get long, just say somewhere in here. Stop loss will go below the rejection candle. You may want to give it a little bit of room below the guarded low. Target, you're going to be looking at equal highs as a first TP. And then for further continuation. That's the long setup. And that's an objective approach to placing a long trade using smart money concepts. Okay, now let's look at a sell setup. Okay, I'll just rewind this back. If you guys want to take a screenshot of this or pause the video, feel free. But this is the long setup. If and only if this presents itself in the markets, then I'll be looking for a long trade. Okay, let's jump onto a sell setup. Keeping it very simple for you guys. Okay, so sell setup. We have a low in the market, followed by a lower high, followed by a strong break to the downside. So clearly, we've broke structure to the downside. We can mark this on as a BOS, a break of structure. Okay. We can mark on our invalidation level, our guarded high. Okay. We don't want price to close above here. Okay. We can also mark on our impulse to the downside. Okay, so this is our impulse. You may need to adjust this slightly, but for the most part, this is our impulsive move to the downside. We're only looking at this gray area here in order to take a trade out of. We can mark on our extreme supply, which is the only area that we are going to be looking for a short from. So if and only if price comes back into our POI, then we can look for a short trade. Okay, I'm just going to mark on the structure to make this very, very objective and clear for you guys. Let's mark this on in red to show the bearish structure. So we have a lower high, followed by a lower low. Once we've seen that, we're interested in sells on this market. We're looking for a price to come back into our extreme supply. If and only if price rejects this area strongly, then we can look for a short trade and look to trade that to the downside. So if we get a rejection, say here, we can enter short, aggressive stop, or I guess you could say a conservative stop here, and a even more conservative stop would be just above our guarded high. So we'd be looking at a stop just above the rejection wick or a stop just above the guarded high. It really depends on how the setup's looking. And then as a first TP, we're going to be targeting equal lows there, and then all of the liquidity below them equal lows. Okay, so first TP is going to be around equal lows, and then we're going to be looking for further continuation to run them stops to the downside. Any buyers that try to get in this market too early, all of their stops are going to be below here, and we're just going to run them to the downside. Okay, so this is the sell confirmation, entry confirmation, and if and only if this presents itself in the live markets, then I will be looking for a sell setup. Okay, one thing to point out here is the retail perspective. All right, so when price breaks here, retail traders are going to be like selling on the break. They're going to be selling on the retest here. So selling on the retest, selling on the break. And you can really see why retail traders get trapped, and retail traders, 9 out of 10 lose money. Because if you're entering short here, you need to understand that price can come back to our extreme supply at any point. And it does. It happens a lot, okay? So if you're selling on the retest, selling on the break, if you've got to stop here, you're just going to get run over. If you've got to stop above here, the guarded high, or halfway between, you're still getting stopped out, even if it's above the guarded high, right? Price can still come and wick above the guarded high, still stop you out. Also, I would say is your risk to reward is atrocious, right? So your risk to reward as a retail trader, you'd be looking at something like that if you choose the guarded high as your stop, whereas our stop is going to be something like this, right? It's going to be something like this or something like this. It's completely different, right? And it changes the game. Okay, so that's how retail traders get trapped. They're selling on the break, selling on the retests. You need to be selling from extreme supplies. Otherwise, you're fighting an uphill battle. You're fighting a losing battle. Okay, so this is the sell entry schematic. Okay, I hope this makes sense, guys. Maybe you need to watch this video a couple times over and over. But yeah, let me know your thoughts on this one. Please like, comment, and subscribe. And I'll see you guys in the next video. Take care, guys. Bye-bye.